A tsunami of money printing is about to pound the markets. Rather than end the war and sanctions, Europe will print trillions to pay energy costs. Laugh out loud. $1.5 trillion margin call just to bail out the energy sector, and then trillions more to essentially pay for everybody's energy as long as these bills remain 400 or 500% higher. And companies are going bankrupt through Europe lightning speed. So buy these 6 stocks right now and get rich by Christmas. We're betting essentially we're heading to a deflationary period, and our high risk portfolio is now up 32.5% total return year to date after returning a 233% return in 2021. Let's take a look at the current trade alert. This is the unit of investment. All of our members follow the same ratio of shares per unit. 1 unit currently comes in at a cost of $2,317, and it's built by buying 19 shares of UVXY, 36 shares of TMF, 14 shares of EUO, 57 shares of ETHE, 27 shares of FNGU, and 1 share of NRGU. UVXY is your crash insurance play. TMF is betting that we're heading into a global slowdown and that interest rates have peaked and will fall. Ticker TMF, that's 3 times the long end of the US government bond, which hit 3.5% yesterday. If it goes any higher than that, it's going to snap everything. Next, we're long the dollar versus the euro. As long as they want to keep this war going on, the European economy is going to a deep recession. And they're about to hike interest rates into a recession. It's going to completely collapse the economy. So dollar can outperform euro as long as this remains hawkish at the Fed. So we'll get some better idea of what's coming up with that. Thursday speech with Powell, CPI next week, and then the monetary decision at the end of the month for the US government, Federal Reserve. Our growth plays with the Grayscale Trust, ETHE. We're long tech with 3 times leverage. This is 12 companies, 2 out of China that are down about 80%. And then all the big US tech companies, they get massive call option buying. They outperform all their peers. They have monopolies, beautiful companies long term. And then finally, we're hedging against inflation and the war with NRGU. And if what the politicians are talking about occurs, NRGU is going to skyrocket above 600 into winter. So we want to hold on to that as long as this war is going to go on. Now, again, if you're catching this on YouTube, you're going to miss out on the end where we go through the exact buy and sell alerts. You're not going to get the updates and you're going to miss out. You also don't have access to the membership area where you can punch in how much money total you have to invest, and it auto calculates exactly what to do. So don't miss out. Call Dean to discuss your portfolio and get a membership today at 505-322-7515. Step 1, buy 19 shares of UVXY. This is a leveraged bet on the VIX. It's a crash hedge. It only works if there's a complete disaster in markets. And so some reasons to maybe think that perhaps there's another down leg in the market. Whenever the dollar index goes up this much, lots of crises unfold. And the main reason why is it means other countries, primarily Asia and Europe, are weakening and their currencies are falling in value against the dollar. And this is very problematic because it means they're not going to be able to service the interest payments on their debt that's denominated in dollars. So they start to sell US assets, US treasuries, US equities, simply to come up with the cash to pay their interest rates. And there's a mind-boggling $13 trillion that's denominated in such fashion. So if the Fed doesn't start printing dollars and stopping all this hawkish talk, DXY could go even higher and create a massive fiasco globally. Now, I don't think they're going to do that. Just in case they do, we're ready. And we will load up the boat on UVXY if we think that's the case. Now, the only reason I would think the Fed would do that is if the CPI next week comes out too hot, then we likely will double or triple down on UVXY. For now, I think we will see a falling CPI and a bullish market heading into midterms. Don't forget about politics and how it impacts markets and decision making. So UVXY in the March 2020 lockdown, S&P 500 fell 25%. This puppy went up 1,000%. Again, it only pays off when there's an absolute fiasco. Also, it's important to note, lots of times when the Fed goes into a hiking cycle, they end up crashing things by making interest rates slow the economy too much. And so these red lines point out various crashes led that were preceded by the Fed hiking rates too far. And once again, we're at the risk of this. So this doesn't show you all the times they've quote unquote pivoted and saved the market. So it's a little misleading on that front. And now, while most of you have lived in 40 years of a bull market, essentially with only a few little sell-offs, it's important to note stocks don't always go up. Over the last century, we had a 19-year essentially flat return in markets in the early 1900s, leading into World War I. Then we had the Great Depression and World War II. And then we had the great stagflation, inflation decade in the 70s. So those are three periods you want to be able to navigate that most of you perhaps were not really tracking stock markets as closely in that period. Zero Hedge writes, the countdown to the credit event begins as the 2-year hits 3.45%. That was earlier in the week. Now, again, I do think we're going to pivot and that inflation is coming down, that we're going to have not have this huge chaotic crash leading into the midterm elections. We also got China's elections, and we've got the Europeans on the brink of a disaster if they don't essentially bail out the consumers there on the energy costs. Step 2, buy 36 shares of TMF. This is like owning the TLT times 3. You'll note we like to use leverage products in a well-balanced portfolio where one asset goes up, the other can go down, but in time, we believe all of them will go up together in general. This helps us get greater returns with less volatility. And again, this is the deflation hedge. So what is keeping the CPI sticky right now? There's only a few inputs, and mostly it's just two. So protein is the third, but I'm not going to throw that up there. I did delete that screen. The main ones are the rent input just hit a new high, and hourly earnings are skyrocketing. We have 2 jobs available per one laborer. And while the jobs keep adding up, what we're seeing is people are having a hard time getting by. They are quitting full-time jobs to get 2 better paying part-time jobs. This is a roadmap about how the economy responds to interest rate hikes to know if what the Fed's doing is working. And the main thing to watch right now is the housing market. Is it selling off and slowing down? Absolutely, it's crashing. If they overdo it, we're going to start to see new orders plummet. We're going to see profit margins contract, and then you get the layoffs at the very end. So the Fed, if they're not careful, could send us down a bad path here quite quickly, which would change our outlook on how to play the markets. Now, this is the composition of inflation in Europe compared to the US. And what's critical is where is the problem? And so predominantly, it's a supply side issue. This is something that the Federal Reserve can't do. They can only crush the demand. So if you look at the Eurozone versus the US, 30% of the inflation in the US is demand related, while only 15% is in Europe. So the ECB may hike rates 75 basis points tomorrow to try to crush demand to help the inflation. But the problem is that's not where the inflation's coming from. It's coming from a reduction in supply of energy due to sanctions they've put on themselves. So what a mess. They're now planning to print trillions of dollars to suppress energy and not fix the supply side. So this is going to likely be a very short-term fix, something like drinking booze to get over a hangover. But the reality is you're going to make it worse in the future. So really the solution for fighting off Russia is about the exact opposite. We'll see how long it takes people to figure this out, but they need to get energy costs to crash and dramatically increase the supply so that everyone's not reliant on, of course, Russia. Now there's Zoltan's pointing out $22 billion worth of natural gas from Russia creates $2 trillion of economic output for Europe. And guess what? Russia has just cut off all the natural gas. Now, the US can help fix their inflation problems with rate hikes by helping reduce the supply side, the demand side, because it's 30% input. But we also would be far better off investing in more energy production, which is not happening at this point. So why has the bond market been so upset and retesting the recent lows? It's all the pain from Europe. And we can look at their producer price index hitting 37.9%, upsetting the entire European bond market, which is now leaking into the US market. And we have double-digit inflation in 6 Eurozones, as low as 10% in Spain, as high as 25% in Estonia. So this is where the problems are being created. Now, it looks like they're going to try to do yield curve control like Japan. So buy their debt while raising interest rates and injecting trillions through fiscal. So something that's never really been done before. Raise rates and print money at the same time. Meanwhile, we've got 10-year yields going back to new highs in Greece, Italy, Spain, Germany, and the US. And what's the impact? This is crashing what is supposed to be an aggressive exporter of heavy machinery in Europe, primarily coming out of Germany. So you can see they went from a massive trade surplus of $300 billion a year for a decade to a negative input. Okay, so this is not sustainable. They have to get these energy costs down. What the sanctions are doing is bankrupting all of Europe, and it's keeping energy costs high. So Russia's actually making more money than they ever have, ever in the entire history of Russia. It's also happening in one of the key export countries, South Korea, which is often used as a canary in the coal mine to predict a slowdown in the economy. So we're quite confident in general. These high energy costs have created demand destruction and that we're in a deflationary cycle now. Some other notes on the housing market: 5.4 million households are not current on their mortgage. 21% of homes for sale had a price drop in July. Median rent is up 14%, but that's a lagger. So we do believe rent will top off and fall and stop hitting the CPI so bad. Medium host price is down 6% in the last 2 months. Record 8% of listings lowered their price each week. That decline is accelerating. The core inputs for inflation are all crashing. We got lumber down since May, down 52%, tin down 47, cotton down 30, wheat down 23, copper down 22, gold even down 11, sugar down 7. Really, the only thing that's gone up, and where we've made most of our money this year, is natural gas, which has also been crashing on Boyle. So we may even get a new trade alert back into Boyle if we're lucky. We sold at a very high level, over 110, I believe, 115, and now it's back down to right now at 74. If that goes towards 40 to 50, I'll get you back in, as long as this war is going to keep marching on. And the bad news, it absolutely is. U.S. just pushed for $13 billion to go to Ukraine, and we'll look at some more commentary on that when we get towards the end. Deflation: top 50 components are deflating right now. So we're very confident CPI is going to fall here. Seth Golden says we're literally living through a period where a strong and now seemingly accelerating economy, while the majority of inflationary inputs are either deaccelerating or outright falling. So it's going to work out well for markets and get a pivot here in the next several months. 42% of CPI components are deflating off peak. Inflation could fall faster than consensus expects, says Tom Lee. Now, Raoul Paul has been big on the bond market. He says, I must admit bonds are super frustrating right now. Break even sharply lower, inflation peaked, oil lower, commodities lower. The dollar sharply up and growth lower globally, but yields are up. 5-year real rates are going to cause a big problem along with the dollar. And here he points out US ISM manufacturing prices paid versus CPI, showing the extreme correlation and now how they have essentially decoupled. This is predicting CPI will fall, as will interest rates. Lawrence McDonald says since Powell's speech a week later, I think we're about 2 weeks later now, DXY is up 2%, NASDAQ's down 7%, corporate bonds are up 90 basis points, junk bonds are up 62 basis points, treasuries are all rising. The VIX is up 18%, Bitcoin's down 8%, gold is down 3%, emerging markets down 4.5%, and commodities are down 4.8%. Not many places to hide except being long the dollar. Now we do know why the housing market's falling. We've got skyrocketing interest rates with prices at extreme levels relative to income. The housing affordability index is back to 2008 levels. Now we have exploding inventories. Phoenix inventory up 177%, Provo, Utah 168. Even down in Florida, inventories are piling up. Tampa up 101%. David Rosenberg says, as the Fed goes wild over inflation, yesterday's story, it is aware that rents are slowing, used car prices are falling, commodities are in a bear market, supply bottlenecks are easing sharply, wage rates are settling down, and freight rates are tumbling. And so he's always a big bond bull and probably not happy that bonds keep getting tested to new lows, but he thinks the Fed needs to pivot here. What direction have home prices moved in the last month? 35% are mostly flat, 35% have been lowering prices, 45% have flattened, and 20% have increased. If you look just a few months back, it was the exact opposite. In February, it was red hot with 89% of house prices increasing month over month. Perhaps what the consumer cares about a lot is the price at the pump. And that keeps falling to $3.77. And so what else is going on in bond markets? Japan is not happy with rising rates. They will do anything to protect their bond market, even at the cost of their currency. And so they say they're going to boost bond purchases. Lark Davis says, while we don't have the final numbers, it's looking like the UK is going to do an emergency energy package of 170 billion pounds. That's about 7% of GDP. Print it, baby. So they're saying they're going to have to essentially protect their bond market if the government wants to issue a quick 170 billion pounds. And that's just the UK. Imagine every country in Europe doing something similar. Marko Kolanovic says inflation will resolve on its own as distortions fade and likely drive a Fed pivot. A stronger H2 recovery in China should provide support for the global cycle in combination with still very low investor positioning. This creates a positive environment. Meanwhile, most of China is in lockdown, trying to conserve energy and food. So until those energy costs go down and we get this official pivot with the Fed to weaken the dollar, China is trying to protect their currency, bond market, and reduce consumption. But the second we get the Fed pivot, look for China to stimulate aggressively to close out the year. There's record searches to sell cars. People are rushing out to sell the cars before they lose that value they had running up on it. So next week, we'll see where this core inflation print comes in. I bet it's going to be lower. I have no clue how much lower. The lower it goes, the better for bonds, stocks, and especially cryptocurrencies. We're seeing the truckload index cost crashing, container shipping rates crashing, and there's massive inventory at big retailers. They're going to have to start lowering prices to clear this out. So with all the deflation happening, you think treasuries would be loved by now, but they're not, down 18% in the last 3 months, screaming buy. Once you realize governments must manipulate interest rates lower to grow debt. This is one of my favorite plays, getting ready to increase positioning. Now, treasuries can go up. If the whole thing falls apart and snaps, you're going to make a lot of money in treasuries. Or if we just get a soft landing and inflation's falling and the economy remains strong, treasuries also go up. So it's a double whammy. TLT, you can see, went below 108, hit 107.50 yesterday. This is a line in the sand that the Federal Reserve must guard. Otherwise, things will start to snap. So there's going to be a lot of effort to protect that level at 3.5% on the 30-year. The investment grade bond market following the same pattern. This is how your big top-notch corporations raise capital to do stock buybacks like Apple, Microsoft. The junk bond market getting hit, down similar amount, also problematic. So funding for corporations is tightening and interest rates are rising. This is the fastest rise in the 3-month government bond in history. So just a sudden inflation shock has hit the markets this year. Is that going to continue or about to slow down? I clearly believe we're about to slow down. So I think these bond market's going to start to cool off here. And you can see the trend is to head towards zero over time to help grow debt. 2-year doing the same pattern. And also in the 10-year, same exact setup, except we have higher interest rates on the 2-year than the 10-year. So this is telling us long term, the bond market believes inflation will go down and that growth will slow down. But in the short term, the Fed's going to have to hike rates even higher. And so that's really what we're seeing in these markets. And you can see a lot less pain in the longer end of the bond market. Here's that 30-year retesting the 3.5 yesterday, coming back down a bit today. I believe this has primarily been China, Japan dumping US treasuries to protect their own currencies is primarily what we're seeing here. So there's a lot of reasons to get these interest rates down and to protect our own bond market because they're all connected. Italy, same chart pattern. So again, some of the key inputs that have been leading markets, lumber futures just totally demolished. Still elevated from historical highs, but way below that peak inflation over the past year to date, down 61%. Copper futures crashing significantly, still elevated levels, but once again, down 21% year to date. Baltic Dry Index, the cost to ship commodities between continents, down dramatically. I mean, from 5,000 down to 1,100, down 51% year to date. Wheat futures are starting to get a bid again. So a little bit on wheat futures, but still way below recent highs. CPI here at 6. We'll see how far it falls. It hit 5.9 last month. I believe it will probably hit maybe 5.7, 5.6, and market will like it a lot. PMIs have been falling, danger of going into negative territory below 50. The Michigan consumer sentiment is at crash levels last seen in 2008. Typically a great time to buy stocks because everybody's so negative. They think the inflation will never end and get worse and worse and worse. And that's exactly when we're at the peak inflation. Initial claims are starting to cool off. We saw that rising, but that's been falling back as we've had decent labor prints over the last 2 months. The inversion of the yield curve typically signals the Fed needs to back off the hiking, otherwise cause problems. And so quite likely they're going to have to do that either in the September meeting or the November meeting. Otherwise, the bond market crashes, the dollar takes out everything, and we get a global stock crash. So we'll pay close attention to that. Only thing that would make me think the Fed would do that is if the CPI stays flat or goes up next week, which again, I highly, highly doubt occurs. Step 3, buy 14 shares of EUO. That's the quantitative hedge. So until we officially get the Fed really pivoting, it makes sense to go long the dollar against the euro with a strong economy that has inflation under control compared to a weak economy that has no control over the inflation. Bob Elliott, who used to work for Bridgewater, says the PBOC is propping up the yuan, the CNY, creates a drag on U.S. assets. Selling U.S. bonds to buy their own currency is like increasing quantitative tightening, but much less orderly. And he says they had to do this in 2015 as well. Now, remember, we got the big pivot, the big stimulus, and a massive melt up after the 2015 crisis. Which was very similar to what China is facing now, problems in their real estate market and domestic economy. Chinese state-affiliated media says the U.S. had better impose fewer sanctions and create more conditions for the U.S. dollar to serve world trade. China does not want to threaten the status of the U.S. dollar. and the US itself should not damage it. And this is after the headline that China and Russia will trade in yuan and rubles instead of the dollar. Here's that DXY index. You can see in the 80s it went to 160. The dot-com bust, it hit 120. Today it's at 110. If this keeps at this level and keeps going up, we're absolutely going to create some major problems in markets. But the inflation is cooling off. So will the Fed start to signal they're going to slow down all this tightening and get us that pivot we need to get the dollar index down? If so, look for cryptocurrencies to skyrocket. EUO is up 30% year to date, one of the best trades outside of betting on natural gas. Here's what's happening to the Japanese currency while they protect their bond market. It's lost 25% of its value against the dollar. China's currency's lost 10% of its purchasing power. And the ruble's the only thing that's outperformed, up 24% against the dollar. Here's the US Federal Reserve's bank balance sheet. So they're supposedly going to start dumping $3 trillion of debt to the banks. The rumor is perhaps they'll set up a reverse repo that allows these banks to take the debt, park it back at the Fed, and get a loan to inject into the economy. So we'll see how that works out. Now, if they don't come up with some shenanigans like that, I don't think they'll get away with selling $3 trillion of US Treasuries into the market without breaking the bond market and financial system itself. Just too much to sell off here. If you look through history, the only time they tried to do this for a very long period of time was under Trump's watch, and it quickly created a crisis and led to nearly doubling their balance sheet. Europe's trying to do the same thing, but now they're going to have to inject trillions of fiscal support. So I do not think they'll get away with much quantitative tightening there. They may have to actually do rate hikes while printing, while buying their own bonds. So QE with rate hikes seems to be what they're trying to do in Europe. Len Alden says the supply of dollar deposits is less inflationary than Bitcoin or gold year to date. Zero growth, and yet people are somehow shocked the dollars are doing so well. If you look at the chart, I want you to note how many years in the last 20 has the US not printed dollars? Okay, and the answer is essentially zero. So this is the only time we've done this, and it's not sustainable. They will have to grow M2. Luke Groman points out foreigners own 17 trillion net, 40 trillion gross USD denominated assets. He basically says if the dollar keeps going up, people are going to have to sell stocks and bonds to cover their dollar needs, and this will crash the tax receipts and make the government insolvent. So there's a lot of reasons why the US needs to stop the dollar from going up and slow down interest rates from rising. Step 4, buy 57 shares of ETHE. This is our ultimate growth asset. Okay, so if interest rates are going to fall, you'll make good money with TMF. You're going to make amazing money with ETHE. And this is in the environment where we're not having a complete collapse of markets. We're getting inflation to go down, and that's why rates are falling. So this is looking at a double bottom, triple bottom, which we're seeing in stocks, and that this has happened in the past, predicting we're about to shoot up in Bitcoin. This modeling is looking at the ratio of each cycle going up about 5.5%. So this is pointing at around $140,000 Bitcoin and a 3.6 times return. Last cycle 20 times, cycle before that 110, cycle before that 600. And Ethereum is younger than Bitcoin, and I think it will potentially overtake Bitcoin's market cap this cycle. Maybe they get very close neck to neck this cycle, and the next cycle Ethereum can overtake it unless Bitcoin starts to solve problems that Ethereum does, because right now it's really just the best form of money, but it's not really taking out its competitors in finance. This little thing is talking about the proof of stake merge happening in about 10 days, 8 days for Ethereum. Few highlights. We're going to have $16 million of daily selling from the proof of work miners eradicated. In fact, if you don't sell 0.3 million a day of Ethereum, the price should go up because the supply is shrinking with the new transition. That's one. Two, you're now going to have a huge incentive to stake your Ethereum to get about a 5 to 6% dividend. Okay, this competes with all stocks and bonds out there, except this asset could go up 10 times in the next 10 years at least. And then furthermore, proof of stake is far more efficient than proof of work. So transaction costs and speeds are going to be dramatically increased. This should help adoption, which means more use. And that's really what's really important. The risk is proof of stake, an old technology that can be corrupted. We'll soon find out. The market cap's so huge on Ethereum, I'm not too worried about it. Meanwhile, the writing's on the wall. Big money is moving in. BlackRock picks Coinbase to provide clients with direct Bitcoin exposure. These guys control $10 trillion. They move just a few percent into the market. It's going to attract trillions of dollars and potentially double, triple, quadruple the entire market cap. And as far as adoption goes, we're early. Okay, most of these different technologies took several decades to have widespread adoption. Assuming it is going mainstream, Bitcoin is very, very early. You've got a lot of time to buy and hold this asset for massive growth. Now, in 2015, while China was collapsing, Bitcoin double bottomed, and we've just done it again. So the 200-week moving average is a screaming buy signal right now. The RSI is a screaming buy signal. We just got through the worst month ever for Bitcoin, the worst quarter ever for Bitcoin. Ethereum is about to offer a dividend that is better than even energy companies, and debt is growing at rapid pace. The US federal budget deficit is anticipating $1 trillion deficit 2022. It's probably gonna be a lot more than that. It's gonna grow to 2.3 trillion in a decade. That's the main reason why you want to buy cryptocurrencies. You believe governments will spend more money than they make at an accelerating pace over time, causing their currency to be devalued and to force central banks into buying up debt and diminishing the value of their currencies. And this has been a century-long trend that has rarely changed. In fact, it's accelerating. What took 215 years to hit 7 trillion in debt was accomplished in 2 years with the crooks in control over the government now. Ethereum in 5 years is up 401% after this massive crash, and we believe we're entering the next bull cycle right now. 51% decline year to date. And if you're in the Grayscale Trust, it's a little worse, 57%. Now, if you are a paid member, I want you to note you can actually get a leveraged position in Ethereum and the software applications being designed, managed by myself. So for every dollar you put into Rebel Dividends, our private equity company, which is designed to replace your ETHE or your GBTC position, you're going to have $1.40 to $1.50 of exposure to crypto, a weekly dividend, and we're going to diversify it. We're not just going to own Ethereum. Think of Ethereum as Windows operating system. We're also aggressively buying all the software applications that are having extreme success that are competing with other markets. So you get the altcoins. These altcoins in the last bear market leading up to this crash, some of them outperformed Ethereum 10 times. So call Dean, sell your ETHE, your GBTC, buy shares at Rebel Dividends, follow the entire plan and get much better results. If I'm right and we're on the verge of the next bull market, Rebel Dividends is going to greatly outperform ETHE. Step 5, buy 27 shares of FNGU. This is the same play. It has a very similar return as ETHE. You're buying 12 tech giants that have monopolies and massive call option buying and massive share buyback. So they're shrinking the supply of these shares. They've got this mad crowd of people that buy out of the money call options. And when inflation falls, growth falls, interest rates fall, you want to have exposure to tech, crypto, and bonds. And so we got all three of those. Similar pattern in the stock market here, looking at the S&P 500 index back in 2003 with the triple bottom. Okay, so good news, GDP tracker is up, showing that the whole economy is not about to fall apart. We're just having a slowdown. And so we had 2 contracting quarters, but now it looks like quarter 3 is rising. This is looking at the stock market with similar crashes. This is the 5th worst in history in the first 167 trading days. And typically, assuming that you're not in a multi-year bear market, you're going to have a nice return coming out of that. Bridgewater is raising shorts against European stocks, again, to hedge his long positions. Probably not a bad bet, although if they're about to stimulate into QE, that could turn on him. Massive amount of money going into stock puts and shorting the market. If we get a pivot, these people are going to have to cover their shorts, and this could create a massive melt up. So the big put option buying by institutions is in individual names, not indexes. Very interesting. We've got this massive short covering that gave us the latest run up, which has since fallen back. And now there's over 125 billion short position in the markets. Now, September is usually a weak month. We've got a blackout for stock buybacks, and we've got a lot of automated selling at these levels. So if Powell's not careful with what he says Thursday, and if the CPI is not falling, markets could move either direction. So we'll be prepared. Midterm years tend to bottom later in the year and see large corrections. The average is 33% from peak to trough 1 year later. If you buy into crashing markets and hold for 5 years, your average return is 110%. Okay, so let's take a look at the chart of FNGU. You can see it went from 45 down to 8, currently at 796. I think it went as low as 6 at one point. FNGU is down 23% in the last 3 months, down 15% for the S&P 500 year to date. The NASDAQ's down 22% year to date. Emerging markets tracking the NASDAQ quite similar, 22% drawdown. This chart's looking at when emerging markets outperforms US markets. And so it has 5 times in history. It's part of our safe growth strategy. And I believe as soon as we get the pivot and China starts to stimulate and we start to ease the energy crisis, we're on the verge of that great outperformance in emerging markets. Meanwhile, if Europe crashes faster than other markets, that could be a sign to get out of the way. So far, just not happening. Looks like Europe's going to try to solve the energy crisis with a short-term fix. That should be very bullish for markets. Uranium's getting a lot of attention. This is in our safe growth strategy as probably the most important energy of the future here. Rare earth metals, that's how you get exposure to lithium. We're going to have to increase the supply by about 2,000% just to cover the electric car goals that governments are hell bent on. So that's a long-term position in our safe growth strategy. Some individual stocks we're tracking: Amazon down 21% year to date, Apple down 10%, Alibaba down 31%, plus another 50% last year. Alibaba's a screaming deal. Non-farm payrolls jumped 528,000 jobs in July. Last month's came in at about 300,000. So it's cooling off. That's the kind of level we like to see. Bank credit keeps growing. Consumer credit keeps growing. Retail sales continue to hit new highs, as you can see in this chart. The US consumer is still very strong. With a strong dollar, we can import lots of goods compared to just a year ago, with the dollar index going up so strong. You can see the strong balance of trade keeping that US economy gobbling up goods and services. New home sales have been falling, which is good for how we're positioned. PMI has been falling in China through April and jumping back up as they try to go back online. But they keep this lockdown policy going until energy costs are fixed, essentially. They blame it on COVID, but I think it's really just to help get the inflation down out of necessity. China's exports are still red hot, even though their imports are weak. They need to stimulate the domestic economy as soon as they can get away with it, but they're having to hold back until the dollar starts to fall. Otherwise, it will crash their currency and bond markets, make it very hard for them to borrow and import commodities. Step 6, buy 1 share of NRGU, the Inflation War Hedge. The The German leaders say, I will put Ukraine first no matter what my German voters think or how hard their life gets. Tracy Chigirl says this may explain a lot. I'm no way advocating the invasion, but these are our elected officials. Think about it. Mass protests against Germany's government, sanctions against Russia, which is causing an energy crisis in Germany. Czech Republic, 70,000 people complaining against the government. This is happening globally. The poor of the country, people just not paying the bills, and they're out rioting. Zelensky says there no concessions will be made of any kind. He rang the bell for the New York Stock Exchange. Looks like there's no plan to stop the war anytime soon. They've started their offensive in two parts. So there's a little surprise attack in Kherson where they had a bunch of military hidden underground, it looks like. So far, nothing really exciting to report. Just a lot of people dying and no real changes on the lines. It's been pretty much a standstill here. 70 cities in China are under full lockdown. Again, I believe this is due to the energy cost, nothing to do with keeping people sick. Energy margin calls are seen totaling $1.5 trillion. There's going to be a big bailout, 3 times that of Lehman Brothers at $500 billion. Russia halts gas supplies to Europe until Western sanctions are lifted. Goldman Sachs says at the current rising electricity costs, this is going to take 15% of GDP. Usually electricity cost is 1 or 2% of GDP. Alf says this is a massive speech by Putin. The economy of imaginary wealth is being inevitably replaced by the economy of real and hard assets. His strategy is clear: sticky inflation, higher interest rates on bonds, paying for hyper-financialized economies. So Russia absolutely is in no rush to end the war because it's become extremely lucrative for them. To really fight back at Putin, we need to dramatically increase supply. Looks like their short-term fix is just to print trillions and suppress financial markets with a massive amount of money, which will likely work in the short term. Very interesting developments here. Here's what they're doing with gas. They're shipping it, instead of just using the pipeline straight to Europe, they're shipping it across half the world to China, and then China's reselling it into Europe. Robin Brooks keeps saying this, which I think is totally wrong. Putin has 2 huge vulnerabilities. First, the West controls most of the global tanker fleet. Second, Russia has little storage capacity. So he's saying just make all the tankers stop shipping it and Putin will go bankrupt. The problem is the price of oil would skyrocket to $300 to $400 and cause way more pain for the rest of the world, just with their ability to reduce the supply. Okay, so now if we were able to replace the supply, it'd be a different story. But guess what? They want to do this. Yellen is saying a price cap on Russian oil is one of the most powerful tools we have to fight inflation. Jim Bianco says these 2 headlines suggest a big showdown is coming. G7 set to back a plan to introduce cap on price of Russian oil. All the big banks have calculated this will send oil to $350 and not work. Kremlin, Russia will stop selling oil to countries which support price caps for Russian oil. Buffett obviously thinks this is a critical hedge for his massive Apple position by buying out 50% of Occidental. This is one of the main companies in NRGU. Oil markets remain focused on short-term demand as seasonal changes. So we're getting this big drop in oil right now as the peak travel season is coming to an end. And China remains on lockdown and the SPR is dumping massive amounts of oil into the market. But what's going to happen when China opens up and when we stop dumping our strategic petroleum reserve? And if gas isn't flowing to Europe, people switch from gas to oil. So that's why we're hanging on to NRGU despite this pullback. Here's a look at some of the attacks happening. Really nothing too big is happening. A lot of people are dying, but the lines are not changing much. So I'm keeping a close eye on it to see if it's breaking in one direction or another. It looks like the great big fight for Donbass will be complete in the next 4 weeks, depending on how successful Ukraine is on its offensive. If they fail to push Russia back, looks like Donbass will be taken, and then we'll see if Russia looks for a truce or if they want to just keep this war going, which is what the West seems to want to do. Meanwhile, Zoltan, a bond expert, is saying we're heading into a new regime where the US is essentially trying to accomplish a few things. They're trying to prevent Russia from having a monopoly on energy through Europe, and they're trying to prevent China from taking over Taiwan, to prevent them from getting fast chips and taking over the technology battle, such as Huawei putting 5G all over the world. So we're fighting China and Russia from taking over more control. To do this, the US will have to rearm. We've pretty much emptied out all our inventories to supply Ukraine, so we got to spend trillions on that. We got to reshore manufacturing, because right now we rely on Russia to supply cheap energy to Europe for manufacturing goods, and we rely on China, so that's going to cost trillions. We have to restock and invest in commodities, which we're just not doing. Instead, we're talking about climate change and trying to build solar panels, which just doesn't do the trick, and rewire the grid for this energy transition. So it can be very, very problematic for bond markets. Eventually, this is going to lead to more QE, most likely. Now, where will Russia actually stop? Are they going to be happy taking Donbass, or are they going to just keep marching across? Peter Zahan says they want to take over Estonia, Latvia, Lithuania, Belarus, Ukraine, Moldova, and build a real fortification. So who knows? Likely they will have to stop and rebuild their military soon, because they have lost a lot. So we'll see. At this point, Russia seems pretty content just holding the line and sending massive amounts of artillery, which reportedly they're now getting from North Korea. And this is bankrupting Europe. Okay, October, the SPR release is going to end, so that could be bullish for our NRGU position. Here's a look at our chart. If we break above 600, I'll at least sell half, and then probably shortly after that, sell the rest, depending on where we're at. But until the war ends, I want to hold that position and see how this plays out. And again, nobody seems at all interested. Not Biden, not Zelensky, not Germany, especially not the UK, and sure as hell not Russia. So for now, we hold our energy hedge. Here's the big oil and gas companies we get exposure to with NRGU. Here's a look at oil falling despite all these sanctions. And this could be exacerbated if we really print trillions to suppress commodity prices, at least for a short period of time. Here's oil over the last 3 months falling 23%. Exxon at 93, near all-time highs, but down a little bit. Could it break to new highs? Certainly if we start to make the price of oil go up by trying to sanction Russia. Okay, great. So that's our slideshow, but this is where your video ends if you're not a paid member. So call Dean to upgrade at 505-322-7515.